Hello, everybody. As promised, I'm going to continue to dive deeper into the home equity part of our business. And I think as an originator, one of the best places to start is just to understand all the options that your customer has at their disposal for meeting their cash out needs. So I think most of us could agree that when you think of a second mortgage, most people think of a HELOC or a line of credit. And we know that that works more like a credit card with an interest-only type payment option, and it's a variable rate. So I think one of the things that we can do is refer to a recent TransUnion study on HELOCs and home equity lendings, and they break it down into three categories. The HELOC that we were just talking about, the HELoan, which is basically a fixed rate second mortgage, or the cash out refi on the first mortgage. So we know that all the LOs on the phone most likely would want to do a cash out first mortgage when it makes sense. But we also know that as a trusted advisor, you have to look for what's best for your borrower. And in some cases, if they have a very low rate, like somewhere in the 3s or low 4s, it just doesn't make sense to do a first mortgage cash out. So we do know that if someone does a second mortgage and they do a HELOC, that HELOC rate is typically an introductory rate. It's typically an interest-only payment for the first 10 years or so. And we know that that rate is adjustable and it's tied to prime in most cases. So we know that things will change and adjust. And if they only made the interest-only payment, they wouldn't be paying down any of the principal. So something that was very interesting that we found was in a lending tree study, 64% of all borrowers said they were concerned about the variable nature of the HELOC loan. And if you dig a little bit deeper into this article, the AVP of Navy Federal Credit Union said they expect people to start to lock in on these fixed rate home equity loans versus HELOCs because of the unpredictability of the product. That way people want to switch and go for certainty, she said. That way they know they're locking at a rate that's a good rate now, potentially at the bottom or near the bottom of the market. So if you dig a little further, Bankrate has this tool that actually helps you compare as a consumer a home equity loan versus a line of credit. And one of the interesting things is there's three key answers to these questions that lead this tool or recommendation tool to suggest a home equity fixed rate loan versus a HELOC. So if the borrower is interested in not paying periodically, they don't need to borrow periodically, then the home equity loan is best. If they want to pay it back over 3 years, meaning there's too much potential adjustment, the 3-year mark, who knows where rates are going to be in 3 years. So typically this is going to refer them to a home equity loan versus a home equity line of credit. And then finally, if the borrower wants to just have some type of payment to budget to, not an introductory rate, not a potential adjusted rate as prime goes up, but if they want equal payments and they're going to pay this back over, say, 5 to 10 to even 20 years, that's going to recommend that they go with the home equity loan. So what we've done is we've put together this tool that actually compares the HELOC versus the HELoan. You can plug in different interest rate options. You can plug in different terms. It calculates the principal reduction at a certain point or lack thereof on the HELOC side if they just do the interest only. And it also calculates out the total payout savings. We're going to dive deeper into this at a later time. But if you're interested in getting this tool, I can send it to you. Just comment or message me to say I'd like the HELOC versus HELoan tool, and I'll send it to you right away. Thank you very much. Look forward to talking to you soon.